jobs report, all of this really big coming up. Michael Lee, founder of Michael Lee Strategy, I'm pleased to say, joining me now. Do you head into September with the past performance of big underperformance top of mind?
Yeah, look, I think it's really hard to buy or sell based on seasonality unless you're a day trader. And even if you're doing this for a living, it's hard to get right enough to where it's additive to your overall portfolio. But that being said, historically, leading up to an election is pretty tough, especially September, because a lot of investors will delever, they'll take money out of the market and come back in November. It's certainly what we saw in 2020. They just don't know which way things are going to go. There's a lot of headline risk, a lot of things going left and right. So, taking a little bit of risk off has been a good strategy for September with the market taking off later in the year.
All right, let me get away from all the September doom and gloom because I actually like September. And right now, Americans have more of their financial assets in stocks than ever before. And you've got more stock market millionaires right now in America than ever before. You're a bull. Does that make you optimistic about where stocks are headed? Or do you get a little concerned when you've got that much invested in stocks that we might be getting a little bit frothy right now?
Not at all. Look, I don't. Outside of the Mag 7, the S&P 500 is trading at 17, 18 times forward earnings, which is maybe 1 to 2 turns higher than your historical price earnings multiple. And the fact that we're about to go into a liquidity cycle does not give me cause for concern at the moment. I think what you're seeing with so many stock market millionaires is a reflection of inflation. So over the long run, inflation is good for large public companies. It inflates their revenue, it inflates their earnings, and stocks are your best long-term hedge against inflation. And if you look at like the Qs versus gold over the last 20 years, the NASDAQ has done, or the triple Qs have done almost 2.5 times gold has, and gold has been pretty spectacular. So this tech-heavy driving of the overall indices, I think, is what's driving a lot of people to be millionaires, because most people are just buying the S&P 500 in their 401k through the form of an index.
Michael, but inflation is sort of a two-head monster here. In some ways, it inflates the market and is good for corporations to a certain degree. But at the other, on the other side of the spectrum, it's bad for consumers. And with earnings season coming to a close here, we've gotten conflicting reports of how this consumer is holding up. They're still trading down to try to save money. I mean, it's been a rough 3.5 years with the kind of inflation and those sticky price hikes that are still there. So I'm wondering, still, 3.5 years later, if there's a crack point for the consumer where they just pull back so much, they tip the market.
Yeah, well, look, I think you have a bifurcated consumer, and you have some winners and losers. So Walmart had great earnings, but Amazon missed on their retail sales side of the equation. So, and then obviously the drama with Dollar General collapsing 20% last week. So, look, I think people at the bottom of this economy, and not necessarily the bottom 2/3 of this economy, are struggling. Subprime auto loans, default rates and delinquencies are at all-time highs. You look at credit card delinquencies for the bottom 100 banks, or banks outside of the top 100, are at all-time highs. The top 100 banks getting near all-time highs. Credit card debt, all-time highs. It is getting really, really ugly for a lot of people in this economy, but the amount of wealth that's controlled by that top 5, 10, 15% really can power us along. So from a macro standpoint, I'd say the consumer is not as healthy as advertised, but we're not falling off a cliff with it, with the specification that it is bifurcated.
Great comments. Michael Lee, appreciate you joining us to kick off September.
Thank you very much.